So what do I mean by massive profits? If you were looking for 5% on your money over a year at a bank, well, that might be a tall order. However, 5% for an overnight swing trader, well, that's actually on the low side. There are a number of factors to consider, which we'll get into in a moment, including advanced strategies. But first, let's just talk about overnight swing trading. Swing traders fit in a world between day traders and long-term investors. And overnight swing traders are a very specific group of traders which use specific overnight trading strategies. And these strategies commonly make 20, 50, 100% overnight. The strategy we use here is called SPY T trading, and there are three parts to it. First is the overnight swing trade. We buy our options or stocks or leveraged ETFs at the close of the trading day, and we sell them generally first thing in the morning. Now we have a signal, either up or down, and there are a lot of different ways in which you can use signals. There are different types of signals. We use the signal on the front page of spytomorrow.com. And not only that, we have a very specific ratio because there's something that we can't do that day traders do. So let's talk about it. Day traders, well, they use stop losses to protect themselves. In other words, if their security goes down to a certain level, they have an order to sell automatically. That can also be used the same way for up. So if they have a, say, 1% target, it could sell automatically for them. But we can't do that as overnight swing traders. So we use a hedge. We take a cue from our signal, whether it says up or down. If it says up, we would buy a ratio trade, meaning we would buy 2 calls to 1 put. That's a 2-to-1 ratio. But you can also use a 3-to-1 ratio, which we call a SPY T Q trade. But we have SPY T A, SPY T B, SPY T C, SPY T D, SPY T Q. We have a lot of different trades and variations of those, depending on the market and how aggressive we wish to be. Although we don't have stop losses, we do have what I consider an advantage over day traders, and that is the removal of the emotional element. Not 100%, but a lot more, because once you buy at the end of the trading day, there's nothing you can do until you trade in the morning. So in other words, we take some of that human error out of the equation. Seriously, emotion is what takes out most traders. Once you decide on a signal, whether it's the SPY tomorrow signal or the put to call ratios or money flows or advanced decline indicators, it doesn't matter. Once you decide, you should stick with it for a while. Don't chase indicators. Get to know your indicator well so you can develop trust and understand in which situations is it most correct. In the case of SPY tomorrow, I like to go beyond the up or down indicator. I want to see what the confidence levels are. I want to see if the other algorithms are also pointing in the same direction. I also check in on the purple max G, because if it's 0, that could mean we might have a flat opening, and that may change the way I approach my overnight trade. As you gain experience, you'll gradually learn that there are better times to trade than not. You don't have to trade every single night, even though you're an overnight swing trader. You don't have to trade every night because there are times in which conditions are not right for the overnight swing trade. For example, when there's big news on the horizon, maybe there are big earnings for Apple or Google, or there's news that's going to come out in the morning from the government. And perhaps premiums are inflated because of that. And if that happens, you'll find yourself in the next morning with an IV crush, which means even if your indicator is right, you could still lose money. And there's nothing wrong with using multiple indicators. You could use the SPY indicator with the put-call ratio, or put-call ratio with advanced decline and another indicator. There are many ways in which you can develop your own strategy to help you have some confidence in the type of trade you're going to make, and also to protect yourself, to guide you into the position size that you're going to use that night, which is really important. So let's talk a little more about that. Position sizing will keep you in the game. The best traders understand the importance of position sizing. How much of your portfolio are you going to risk overnight? The thing is, your indicator may be right most of the time and then you gain confidence, but sometimes we gain too much confidence. And what will eventually happen, which always happens, is that your indicator will be wrong for maybe 2 or 3 days in a row. And if your position sizes are too large, it could absolutely blow up your account. There's nothing wrong with using indicators to help you decide how much you're going to risk. However, you should have a range, either 5 to 10% or 3 to 7% or maybe 10 to 20% of your portfolio. It all depends on your risk tolerance. But you should have some sort of an indicator to help you out. For example, I have my confidence indicator at spytomorrow.com, and I know if it's a 0 or a 2 or a 4, there's a much higher risk of the indicator being wrong. If you watch my other videos, you probably have heard me say it many times before. When you buy is important, but when you sell is what's going to make you a great trader. Now, we buy at the end of the trading day and sell first thing, generally in the morning, but over time, you'll start to realize you could have made maybe more money if you held on a bit longer. So it's good to have some day trading indicators to help you out, because you could increase your gain by 10, 20, or even 100% just by holding on another hour or two. Being a great trader means you know how to maximize your gains and minimize your losses. Learn how to control that greed and fear, and I'll see you in the next video.